My name is Mark Bowd. I am the Senior Vice President and Chief Economist of Metrostudy. I'm here to share with you the most recent findings of the national edition of the Residential Economic Report. At the heart of this report are modeled forecasts associated with the supply and demand and price appreciation and devaluation of housing. During the past 12 months, there have been 2.2 million jobs created on a national basis. That is consistent with what it has been during the past several months and is creating more demand for housing than we are currently supplying. Correspondingly, the unemployment rate continues to fall. It is currently at a level of 4.4%. The expanded unemployment rate, referred to as U6, is now at 8.5%, and that has also fallen fairly significantly during the past 12 months. The labor force participation rate, which fell dramatically during recessionary years, has finally begun to climb during the past 24 months. It remains far lower than the peak level achieved in 2007 of about 66%. If we were to reach that level of 66% labor force participation, it would translate to 7 million more people in the labor force today. Our housing starts level for year 2017 is estimated at 1.26 million starts on a national level. We expect that to climb to a peak level of 1.44 million housing starts by year 2019 before beginning to plateau. There are higher and lower forecasts, though the base level forecast is the one that is most likely to occur. Though housing starts will continue to increase during the next few years, they will likely not reach the peak level of over 2 million housing starts, which was achieved in year 2006 during the previous cycle. Overall, about 25% of all housing starts will be represented by multifamily housing, though more and more of those multifamily housing starts will be represented by for-sale condominiums as opposed to apartments. Our forecast for new home sales within major metropolitan areas will reach 710,000 sales by year 2018. To illustrate changes in new housing market share during the past few years, the pie chart shows year 2000 census numbers at 12% for new housing. By year 2006, that overall market share for new housing had increased to 21%. During the pit of the recession, overall new housing market share fell to a low of 9%. And during the most recently completed year of 2016, it had only grown to 11%. So overall new home market share remains muted and is not likely to increase dramatically during the next few years. The relative lack of new housing construction has contributed to a boom in remodeling activity. Our index for remodeling activity has surged well above the previous peak level achieved in year 2007 and is likely to continue to grow during the next 2 years. This will reflect high remodeling activity of existing homes. This increase in remodeling activity is being fueled by relatively little new housing construction, as well as ease of lending for HELOC loans, as well as an increase in the interest of do-it-yourself activities. A heat map of remodeling activity throughout the nation shows strong activity along the California coast, as well as the Pacific Northwest, select areas of the Midwest and Texas, as well as select areas of the Northeast. Though remodeling activity in the Florida markets is relatively muted, we expect remodeling activity in Florida to increase dramatically as the Florida economy continues to improve. Until recently, mortgage rates had actually declined from levels recorded at the beginning of the year. We expect mortgage rates to gradually climb as inflation concerns increase over time. Our 5-year forecast in mortgage rates reflects gradual increases to a 6.1% level at peak year 2020 before beginning to plateau. Our forecast increases in mortgage rates correspond with our prediction of inflation becoming an increasing concern during the next few years. Overall, for year 2017, our forecast inflation rate is 2.5%, which is almost double the level that occurred in year 2016. Despite inflationary pressures easing during the first half of year 2017, we still expect inflationary pressures to build over time. Revised consumer spending figures show an increase during the first half of year 2017. We expect these increases to plateau during the balance of the year, though at a very high level, which will continue to stimulate the U.S. economy. All of the preceding information was used to update our housing model for the most recent quarter. Housing demand continues to increase at a faster rate than housing supply in the most recent quarter and is likely to do so through the next few years before beginning to decline after year 2020. The result of this is a plateau of pent-up demand which will likely form in year 2020 before declining into a recessionary pattern thereafter. By year 2022, we expect modest levels of oversupply to form on a national basis, though many markets will remain undersupplied. Of more concern is potential overvaluation. Fixed mortgage rates have remained so low for such a long period of time that it has allowed prices to increase at a faster rate than they normally would have otherwise. As prices continue to climb and mortgage rates increase, we expect overvaluation to increase from year 2018 through a peak year of year 2020-2021. Though the level of overvaluation that is predicted by year 2020 and year 2021 is not as severe as the peak levels recorded in year 2006, they still pose risk in many markets throughout the nation in terms of home purchases, land acquisition, and land development. Numerically, the patterns of overbuilding and underbuilding, as well as overvaluation and undervaluation, are shown on this slide. These patterns reflect stability in the housing market during year 2017 and 2018, though the first flag of potential weakness occurs in year 2019. This does not mean that year 2019 will be a bad year in terms of housing sales or price appreciation. Rather, it means that it will be a high-risk year in terms of land acquisition. The Market Opportunity Rankings chart is a new chart added in the Residential Economic Report this quarter. It combines the indexes associated with jobs to housing as well as mortgage cost to income to create a ranking of those metropolitan areas that are likely to represent the lowest risk in terms of housing purchase, land acquisition, and land development. Select southern markets such as Sarasota, Florida, as well as Miami, Fort Lauderdale, and Atlanta are well represented in the top 10 markets. These are markets with growing economies and very strong affordability. The greater Seattle market is performing well in terms of economic growth, though housing prices still represent some value relative to the long-term norm. The San Francisco Bay Area, inclusive of San Jose Silicon Valley, has performed especially well during the past few years. These markets have risen in price and are now overvalued, though this current level of overvaluation is overridden by very high levels of pent-up demand. Also represented in the top 10 markets is the Fresno market area or Central Valley of California. This market benefits from rollover equities from high equity wealth in the coastal markets of California that is easily released during a time of high economic activity and is drawn to the Central Valley due to strong affordability. Also shown on the Market Opportunity Rankings are those markets which are most likely to represent high risk in the current market atmosphere. Though most of these markets represent strong value in terms of housing costs, they have job growth rates that are lackluster at best. The lack of economic support is what causes high risk in these markets. Overall rankings will change over time, but as of now, the rankings shown on this particular slide represent strong indications as to which markets will perform best and which markets should be avoided in the near term. Key takeaways for year 2017 are as follows. Job growth may increase both in year 2017 and in year 2018 from 2016 levels. Overall household income growth will likely accelerate, caused by a very tight labor market. Housing shortages will become more intense. Look for an accelerated and shorter, sharper real estate cycle with a peak in the 2018-2019 timeframe. An extended period of low mortgage rates has allowed home prices and land values to rise higher and more rapidly than they probably should have. Rising mortgage rates may contribute to severe housing overvaluation in many markets throughout the United States, despite only modest appreciation in these markets during the next few years. A higher national debt-to-GDP ratio will lead to higher interest payments, which will eventually dilute U.S. currency and slow the U.S. economy. And then finally, careful research and accurate data analysis have never been more important than in the current real estate cycle. The Residential Economic Report presents these modeled forecasts for every metropolitan area throughout the nation. For more information, visit metrostudy.com.